Hello, and welcome to the October 2023 edition of Ask Our Experts. I am Leanne Casboy, Senior Associate at Civitas Strategies, here again with Gary Romano. Gary, I'll let you introduce yourself.
Absolutely. Gary Romano, President CEO of Civitas Strategies. We are here and excited to read your emails and posts and such for taking care of business. I have my taking care of business pinky ring
Perfect.
handy and ready to help empower me as we are answering your questions. So let's get into it.
All right, first question. So we have a family home provider who is asking about renewing their home insurance for $5,000, but it was increased to $14,000. And they are finding many companies don't offer coverage because it's both for their home and their childcare at the same time. And a second part of their question is whether their home insurance will be residential or commercial because of the business in their home.
So there's a couple of questions here to answer, right? And so first and foremost, I know this reader had asked, we have a list of insurers to share, and that's something we get a lot. Unfortunately, we don't. We don't keep a list of insurers. What I would say is we are seeing a lot more providers who are facing this challenge, where they're seeing their rates being raised. They're seeing, complications as they go to renew their policies. And unfortunately, at least right now, I don't know of any legislation around this or any really good solutions that we're hearing about other than shopping around. In terms of some of the other question or the other part of the question around insurance is, this commercial policy, whether it's residential or commercial, it's hard to tell from just that language. But what I would say is three types of insurance that you want. One, you definitely want residential insurance. That's going to cover the damages to your home. You want a business liability policy. So that specifically covers, any physical damage or injury that happens as part of your program. And then likely you want an errors and omissions policy. And that's also a type of business policy. And that covers any mistakes you may make, right? Honest mistakes that may cause some problems. So if you're offered a commercial policy, it's important to understand which one of those three buckets does it fit into, and maybe it covers two of them. Sometimes you'll have policies where it'll cover business liabilities and errors and omissions, but you'll want those three types of coverage.
Okay, perfect. And we have another insurance question. This one is about an insurance carrier who is denying the provider, and I think that means denying the claim after 8 years because of one claim of $25,000 from a mom who claimed that a bite led to a fracture. They have had 0 claims before this. Is there anything they can do?
So, yeah, and I interpreted that as being like denying their policy, like ending their
Yes.
policy, because we do see
Okay.
that. But it could be either, right? So let's talk through both those options. If they're denying your claim, there's typically an appeals process. It depends on the insurance carrier, but you would want to pursue that appeals process. If it is that they're dropping you, and we do see that from time to time, that insurance companies, especially going back to the last question, we're seeing the insurance for family care in some places go up. Can they cancel you after a claim or cancel you, because you had a claim and then the policy just sunsetted, right? Like maybe you had a claim in June, it sunsetted in August and they don't renew you. Unfortunately, they can't. And there isn't much you can do with that carrier. You do have to unfortunately go to find a new carrier. And that is just the way the insurance system is set up.
All right. Now we're going to go on to 2 related questions, both about taxes. So one is from a person who received funding to replace all of their windows and a slider door. The question is this: I've heard if I replace half or less, I can write off that full amount for 2023. If I do all of the windows in the slider, how does that affect me for taxes? And then the second question is from a provider who has a French double door going to an outdoor play area. These doors have full-length windows in them with blinds. The blinds have been an issue because of the cords on them, and they want to replace them with cordless blinds, and that has been an issue with licensing. So if I replace those blinds, they won't last long because the kids won't leave them alone since they go down the length of the door. I am looking into replacing the doors entirely to the ones with built-in blinds, where the door has a full-length window, but there are 2 panels of glass with blinds in between. Can I deduct these 100% on my taxes?
So these are both great time space issues, and we'll post the time space or link to the time space guide with the video, just so you have it handy. But in both these cases, the factors that we're talking about don't come into play, right? So the 50% rule, there isn't a 50% rule. Like if you go above 50%, it suddenly isn't deductible. That doesn't happen. And in terms of this one, I think the second one, I mean, what the person is saying is because it's leading to an outdoor area that is exclusively used for childcare and is being driven by the children, can the door count as a 100% deduction? No. Everything is driven in time space off of exclusive, regular, or no use spaces. So in other words, if you're using it 100% or close to it for the childcare business, that's exclusive use. Likely everything within it is 100% deductible. Regular use means that your family uses it, but it's also used for the business. No use might be the primary bedroom or maybe your kids' bedrooms, which are not used at all in the childcare business. So just to kind of, go over the windows and doors, if let's say the door with the, built-in shade, which I think kind of looks kind of cool, is an exclusive use area, then yes, that would be 100% deductible. If let's say it's coming off the kitchen that the family uses as well, that would be regular use. So it would be based on your time space. And then certainly if in the example about the windows, previously, if you're changing them in your primary bedroom and the kids aren't allowed in there, well, that's not deductible at all. So stick time space on these.
Okay, perfect. And I will put that link into this, the chat that goes with this. Right, next question. I am an in-home daycare provider who has to move. For taxes, what should I keep track of for moving expenses? And she notes that this is for her family as well as her business.
So moves come up, a fair amount, I think more than people would think. And there's a lot of misconceptions and confusion around them. The challenges are twofold, right? One, as you just said, Leanne, right? You're moving your business, but you're moving your family at the same time. It's not like you're just moving the office, right? The other challenge that you have is, under quote unquote normal circumstances, i.e. traditionally is a better way to put it, a move for business that was over 50 miles would count as deductible. With the Tax and Jobs Act a couple of years ago, that was suspended through 2025. So right here, the personal stuff, even if you're, let's say, moving to another state, unless it is a military-based move, right? So maybe your spouse is in the military and you're going to have to move from Texas to Virginia, let's say, that would be a different story. But if you're a civilian and your spouse gets a new job and you move from Texas to Virginia, the personal side of thing is not deductible at all. So we'll put that aside. Now let's talk about the business side of it. You're going to want to keep very tight records around the business portion of it. So in other words, if you have things that you are moving that are specifically for the business, like let's say toys, records, what you may want to do is figure out how much of the truck, the moving truck, the percentage of the moving truck that's occupied by those things, or something along those lines. I would be very cautious on the allocation, right? So it's not, I've had providers say, it's in the truck, can we deduct the whole moving truck? And you can't. But you can deduct a portion for business items only. If it's shared business and personal, you could allocate them. Time space would not be a great way to do it. You may want to come up with some other percentage, like if, let's say it's toys that are used roughly 50-50 by your kids in the business, then say the truck, 10% of the truck was devoted to toys, they're used 50-50, so I'll deduct 5% of the cost of the move, related to the truck itself. So as you're hearing in this, I hope, one, have a method, have a clear method. Two, you can't deduct everything, only business related. Three, keep those records. Because if you're asked, the IRS isn't going to just want to see receipts. They're going to want to understand, so how did you calculate this, Leanne? Like, where did you come up with this number?
Okay, perfect. Another question from a home provider. My friend and I opened a family daycare this month. We are 50-50, a 50-50 general partnership. Two questions. How should we pay ourselves? And the daycare is located in my friend's house. Can the business pay monthly rent to my friend for using her house?
So with a general partnership, what you're going to do is you're going to withdraw the funds as an owner's draw, right? Which means essentially you're paying yourself. However, know that those are going to be subject to self-employment tax, just as if you were a sole proprietor. So
Mhm.
15.3% of that money is going to go to the federal government. And the state you're in may take money as well. So, and at the end of the year, you get that instead of, just having it on your Schedule C if you were a sole proprietor. Instead, you'll get what's called a K-1 for your partnership, and on it will list, here's the money that you made. And again, that's going to be reported then on your personal taxes. You'll get self-employment tax, and then you'll also get taxes taken out for your income. This is why, just as like a little like footnote, when people do have a partner, I often say take a look at an S corp. It could be beneficial to you, more beneficial than a 50-50 general partnership.
Mhm.
But that's a whole nother story. But do keep that in mind. In terms of paying rent, you can pay rent. And sometimes, by the way, providers say, like, we had a provider a couple of months ago where she lived with her boyfriend. The boyfriend owned the home, and she said, "Can I pay rent to the boyfriend?" You can pay rent to mom and dad. That was another question we got. You can pay rent to the general partner. However, the general partner needs to report that rent.
Mhm.
So whether it's on a Schedule C or anything else, it's considered business income, which means that she's then taking whatever deductions against that kind of business. It essentially becomes a separate business enterprise. So don't just write the check to rent and say, we're done here, because the federal government is likely to pull that thread and say, okay, where's your partner's end of this? Where do they pay taxes on it?
All right. All right. Now I'm going to give you two questions that are related, both again about taxes. One is from a person who owns a family home. I'm thinking of adding an assistant. I might have to pay this assistant. Do I have to go through a payroll service or can I hand her cash at the end of the day? Also, how much would she need to make to be required to claim it? She does not have any other income. Her husband works and is a sole provider. They file as married filing jointly. So I'm not sure if she's a dependent on that or not. Also, how do I go about claiming it on my taxes as outgoing money? And do I need to provide her with anything at the end of the year? And then a similar question, I have worked by myself for over 30 years and have filed my taxes as a sole proprietor on my Schedule C. I do not have any idea about the proper way to pay an assistant or how they and I will then file our taxes. Can you help?
So, so a couple of different things bound up here, right? So we're seeing a lot of family care providers who, through the funds that have been provided by the government, through some of the changes that have happened locally in the way subsidy are paid, or I should say at the state level in their state, they're getting to the point where they can have an assistant, and that's huge. It's great. Um, what I would always recommend is, if you can, use a payroll service, because all of the normal wage deductions have to come out. So even if you're paying them cash at the end of the day, as the first person was suggesting, they're still an employee and you're still going to have to pay them as an employee, which means that you need to, withhold their side of their income tax and their taxes. You need to withhold your state and federal taxes at, your payroll taxes, and you also need to do a quarterly Form 941. We're seeing a proliferation of inexpensive sites. We use Gusto. I don't make anything from it, so it's not like I'm going to put a link in that says, and I get $5. But we know a lot of providers use Gusto. A lot of them use Wave. I've never used it myself, so I can't tell you firsthand, but these are some easy sites that are out there to get that payroll going. So you don't have to do all the forms, but if you're going to do it yourself, you still have to do the forms. So even if I hand Leanne $100 in cash, I still have to do a 941, and I still have to withhold things. The salary portion, as well as your side of the payroll taxes, are deductible. And those are things that you would put on your Schedule C under the wages line. Don't remember which one it is, but it's on the lower left. I know where it is, like spatially. The employee would then report the W-2 income as they would any other W-2 income on their 1040.
All right, we've got a couple more tax questions coming up. Um, would you be able to point me in the direction of a tax professional that knows about in-home childcare? It's been hard, and I have not found one that has even heard of the time space percentage.
It's a huge problem. And unfortunately, we don't recommend tax professionals because, for the most part, I haven't found ones that do it well.
Mhm.
And I'm not going to get on my soapbox, and we have so many questions around how the tax industry is just not built for small providers, but it is what it is. Many of them are unaware of the rules. Unfortunately, there are a number of things that we have, and we can link to our page on taxes where we have a number of
Mhm.
free items for you. You may want to consider self-preparation. Um, we're finding a lot of providers have success. We have a guide that tells you how to do it, your business part of self-preparation.
Mhm.
That may be an option for you. If you don't feel comfortable with that, look at some of those guides we have and bring them to the tax professional with you. We do include a lot of them, the citations and such that your tax preparer can feel confident that it's the right information.
All right. So here's a related question. My tax person will not let me take any hours unless the kids are here. I've heard that you can claim time for cleaning, interviews, bookwork, grocery shopping, etc. within reason. What is allowed to claim for tasks associated with my childcare when children are not present?
So in this case, I mean, this is easy. Your taxpayer is incorrect. You're right. So you can include time with children, and you should, right? You're getting, and your tax preparer is getting. But you can also include other time related to the operation of your business, including cleaning up, food prep, lesson planning, shopping. These are all times that are related to your business that are important. And, and certainly like if you're doing an online training from home, it counts, right?
Mhm.
These things add up, and this is perfectly legal. We do find a lot of tax preparers they're used to the traditional home office. So when you start talking about, being able to do 75% of your home expenses, they get nervous,
Mhm.
but their anxiety shouldn't be your anxiety. And again, if you look at that page, we'll put a link in for it. There's some guides that you may want to bring with you and just say, look, these people just really look at these taxes. They've looked at hundreds, if not thousands of tax returns from providers. This is what they say.
All right. A couple more tax questions coming your way, Gary. Can people
Yeah.
receive a tax write-off for making a donation to my childcare?
If you are a nonprofit corporation, yes, and you have your 501c3, et cetera. I'm trying to think through my database. Maybe there's only one or two family cares that I remember that are
Mm.
nonprofits. It is extremely unusual. And I think with good reasons, that's a whole nother conversation we could have. I don't normally recommend the nonprofit structure, especially for family care. It just doesn't work well. It's clumsy for it. It's a bit too bureaucratic for what you need. In terms of can people write off that donation if you're not a nonprofit? No, they cannot.
Okay. Here's another question about deductions. I have a car lease and I'm wondering if the monthly amount can all be deductible.
So, like with any other vehicle question, everything's driven by mileage, right? The mileage you use for the business versus the mileage you use personally. And the business deduction is a percentage of that, or it's based on the mileage rate. So if you use the standard IRS rate, you use that rate based on the number of business miles, that's your deduction. If you use actual costs, you would include the lease there. You'd include other things that you may have had, maybe oil changes, fuel costs, et cetera. And then you take a percentage of that based on the business portion of the overall miles driven. But there's no way you can make it all deductible unless it's 100%. And I would say, because I know sometimes we get some people who are kind of bold about this one,
Mhm.
the IRS specifically says they look for cars that are 100%, especially from a home-based business. So if you're going to do it, just make sure. And I've had a couple of providers where they said, we have an old van that we use just for moving the kids. Nobody ever drives it otherwise. It's fine. Just make sure you have the proper documentation.
All right. Uh, Another question about taxes. I am going to start my own in-home childcare. My friend loaned me a copy of Tom Copeland's record-keeping guide. I got to the part about deductions and couldn't find a clear answer of this. So I have no children of my own, and so all toys, books, baby items, etc., have been exclusively for business. Does that mean they are 100% deductible?
So if they are for the business specifically, maybe there aren't, grandkids or nieces or nephews and stuff, right? Then yes, they would be startup costs. They would be deductible as such.
Okay, perfect. Another deduction question. I'm wondering about travel and being able to deduct the cost of the trip. My question is, does the trip have to be business related only, or can it be a general trip and I purchase or do something childcare related? Am I then able to deduct the cost or part of the cost of the trip?
Gotcha. And this is an interesting opportunity, but one where I would say, proceed cautiously. And I mean cautiously as in like, you may do bad things. Just make sure you know the rules here. But I think sometimes we do have providers who say, I'm going out of town. I'm going to pick up some credits while I can, some continuing ed credits, that sort of thing, while I'm out there, and there are ways that this can become deductible. So if you're traveling in general, the rule is you have to spend at least half of an 8-hour workday working on bona fide work-related tasks, right? So what the heck does that mean? That means they have to be ones that can only be done on site. And depending on, if you kind of go beyond that point, right, that half day point, then that day becomes deductible. So let's say, for example, Leanne takes a trip to Orlando. She brings the whole family with her. And one of those days, they all go to Disney without her and have a fun time while she's doing the training. Well, the training is 6 hours, let's say. That breaks the halfway point. That day and the costs associated with it for her are deductible as they would be normally, right? So she has a meal. There's the 50% rule that's now back in play this year. There's some other things that are going on, right? But generally about 20% of her trip, one of those 5 days would be deductible. Now, let's say instead, Leanne's family goes to Disney without her and she's stuck miserably in the hotel room catching up on her bookkeeping. In this case, it's not deductible because she could have done that bookkeeping at home. It's wonderful that she chose Orlando to do it, getting some sun, but unfortunately that would be considered something that didn't have to be there.
All right. Next question. I run a small in-home childcare. I'd like to apply for a loan. What is the best way to show my income besides my taxes? I write off the time space percentage of my household expenses, which most loan officers don't understand.
So this is unfortunately, a major issue. And I think it's one that as a field, we haven't done any policy work on, and it really desperately needs to be. So what happens is underwriters by process look at line 31 if you're of your Schedule C, if you're a sole proprietor. And very often we will talk about how do you minimize your taxes as much as possible. But unfortunately, for purposes of a loan, whether it's a business loan or a mortgage, personally for you, they look at line 31 as being your salary. And there really isn't, unfortunately, anything to do that. Because like if you look at the household expenses, those are considered deductions, right? Now, you and I both know you're getting an outsized benefit of that. And that's wonderful, right? We always talk about the importance of time space in part because you are getting an outsized deduction. And that's not a criticism. I'm all for it, right? Laws are there. You're paying attention to the law. You're doing it right. You're benefiting from it. Unfortunately, that's considered an expense, not revenue, right? Even though you're doing well by it, the underwriter is going to look at that as an expense, so it can't be used. So this is something, unfortunately, where a lot of providers, when they're looking to buy a home or looking to refinance, they have to pump the brakes on some of their deductions, unfortunately, to push that line 31 net profit up. And there's unfortunately no way around it right now.
All right. Our next question is from a family childcare provider who notes that they file their taxes and receive most of their payments by personal checks and cash. Question, I save up my cash payments as much as possible for emergencies. And now with attractive savings rates, I'd like to deposit that cash into my bank account. Will there be any tax implications that I need to worry about?
I mean, the tax implications are basically, even if the payments are in personal cash and checks, Venmo, whatever, it's income, it's taxable income. So if you are reporting it on your taxes as you should, then there's really no issue of putting it into your bank account.
Mhm.
However, if let's say you forgot to report them last year, or you were saying, gosh, it's cash, so maybe I shouldn't report it this year, you do have to report it legally.
All right, perfect. Next question is from a licensed home childcare business who closed at the beginning of September. They have reached out to licensing that they no longer have kids, and so licensing has closed down their license. But since that time, the provider has still been working on things related to the business and will soon start working on their taxes. They want to know if they can use that time toward time space, and if they purchased anything such as a couch or desk and used them while working on tax and other business things, can they still be used as a write-off?
So let's break this up into two questions, right? First question, can you use the time in shutting down the business and some of the related costs that might be associated with it? Absolutely, right? The second part of that question is, can you deduct these purchases, for the business? Well, if they're ordinary and necessary, yes. So in other words, if the couch and the desk are absolutely needed to shut down the business, then yes. But I do wonder about that, and I think the IRS may as well. So I would make sure these are clearly ordinary and necessary. Like, for example, maybe Leanne is shutting down her business and she needs some boxes because she's going to sell all the toys and other educational materials she has, and she wants to ship them to a friend who purchased them in Florida. Those boxes deductible, right? But do know that if you take on assets, if you have assets that you've been deducting, they do need to be liquidated and accounted for as you close it out. So for example, if the business donates those toys that we were talking about, so maybe Leanne buys those boxes to bring the toys down to Goodwill, boxes are deductible. The toys, she can get a deduction on, but she does need to have some disposition. If, let's say, she just gave them to her kids and said, well, I don't have the business anymore, technically you are supposed to know how much are they worth right now and report that as, part of the income of the business.
All right.
So with the couch, if you put it in service this year, what happens at the end of the year?
Next question is very similar, and you may have already covered this, but I would like information about closing my licensed childcare when I retire. How will it affect my income taxes? Anything else that?
Yeah, I mean, the biggest things here are remembering to liquidate those assets, right? If there are significant assets, you just can't make them disappear or, sell them at a garage sale and say that's that.
Mhm.
Technically, it is revenue of the business as you're retiring. The other thing I would think about is if you sell your home, and I know you're retiring, so you may not be, but a lot of providers we know sell the home at that time. There's going to be depreciation recapture. We've talked a lot about that in the past, but just be aware that that's going to happen.
All right, next question. I'd like to remove my maternity/layoff policy from my handbook. Can I just remove it and tell my families that I did so? Or do I need to type up that I'm removing it and give them a copy?
So, it depends on how you structure the handbook. Your handbook will typically have a clause that it can be changed at any time without notice. If it doesn't, then certainly you do want them to sign it. Even if it does, my suggestion would be any major policy you have them receive it and sign it. It's just a good practice. It's not something you want to do under the table. Because even if you can then point to a clause that says, well, Leanne, you signed something that said it was okay, they may feel really bad about that. And it may
Mhm.
feel like it was deceptive. So I would say as a good practice, do it either way.
Right. Next question is from the director of a nonprofit childcare center in Texas, who has been trying to find legitimate food reimbursement programs in my state, and some of them seem overly complicated and like they are not worth the time. Can you point me in the right direction?
So, within your state, there are child and adult care food program. There's usually a state agency or coordinating organization. That's where you would find your local agency. I would talk with them very carefully and really hear out what the pitch is and what's required of you. Typically, and by typically, I mean, I've yet to find a provider who doesn't have a positive gain revenue wise. I've said that in the past. Tom Copeland has said that to you. So I would look at that very carefully.
All right. Next question. If I'm using standard meals claim for my taxes, I am on the food program. Do I need to save my receipts for food shopping and proof of mileage?
I would recommend keeping them for proof of mileage, especially if you have combined personal and work shopping, because we've talked about this in the past. If you go to Target, the majority of it has to be for business with a given trip to make it deductible. So that would be your proof. You'd be able to say, look, here's the receipt, and everything but this one item I threw in was business related. So I would keep it for those purposes.
All right. The next question, I'm curious what the rates are for 2023 food program rates. I see the food program reimbursements, but not what we can deduct for taxes.
So we do have them. And those are the tier 1 rates. And so it is, and I know everyone says like, well, wait, the food rates change mid-year. So what do we do? It's the rates in force on January 1 of the given tax year. So for 2024, it will be the 2023-2024 rate. So the ones right now will be the ones you will use all through 2024. For this tax year, for 2023, you're going to go back to the 22-23 ones.
Mm-hmm.
And we could pop those into the comments.
Absolutely. I will put the link in there. And now we are on to our last question. I have sole custody of my daughter, and her dad has visitation every Wednesday, and depending on the year, some Saturdays. I work in retail, so my schedule is all over the place. So this person is not always able to pick the child up from childcare. My fiance has weekends off to be able to pick her up, but her dad does not want my fiance picking her up. He tells me if he does, he's going to tell him something. In the court papers, it does not say mother or father must pick up. Should I go back to court and have on paper a list of people to pick her up if I cannot?
So custody agreements, I always say the same thing. They can be really, really tricky. And unfortunately, this is something where, I strongly recommend it costs you money, but seek advice of legal counsel, and not their legal counsel, your own. So in other words, you don't want to get in the middle of, domestic issues and disagreements and have to trust that their attorney is correct. Get your own attorney. Unfortunately, you're going to have to pay them to look at it and make sure that you're implementing it correctly and legally.
All right. So those are all the questions we had this month. A lot of questions, but we love them. So keep them coming, and we will put the link to submit questions going forward, and look forward to answering more of them next month. And thank you, Derry. Always appreciate your insight on these.
And appreciate you organizing all this, Leanne. Thank you.
All right.